we previously reviewed the importance of protecting your wealth as you build it, which ensures that none of your hard work goes to waste. Today, we cover how to establish the foundation from which your wealth will grow. I left a link to the former of this series in the video description below, so leave a like, subscribe if you haven't already, and let's dive in. By now you've got a clear-cut budget, so you know what you're spending and where. You've also got the appropriate insurance policies in place and optimized. So what's next? Question: if you were to be surprised with a $400 emergency expense, would you have the cash to handle it? As it turns out, about 1/3 of Americans don't have cash reserves sufficient to handle even that much worth of an unexpected expense. How is this important to you? How much would it cost to replace a major appliance, or to replace the tires on your vehicle? Check your deductibles on your car insurance and homeowner's insurance. Most likely, they're at least $500. What if you had a $1,000+ medical expense, and maybe injury or illness causes a temporary reduction in your income? What would be your answer for these potential financial difficulties? Hopefully, a better answer than taking out more debt. One tried and true counter to these seemingly random money setbacks is to have an emergency fund. Consider your emergency fund to be the beginning of your financial offense. Something that you get to build that bridges the gap between you working for money and your money working for you. Once your debt is gone or on the steady decline, and you have at least 3 weeks of your living expenses operating in your checking account at all times, you're ready to start your emergency fund. The general rule of thumb here is to build up 3 to 6 months of liquid emergency cash that has no other purpose but to deal with the unexpected and intermittently recurring expenses. By liquid, I mean I wouldn't use a retirement account or a CD for an emergency fund. Ideally, emergency savings can be accessed quickly and without penalties. And it's not only emergencies that these savings will help with. Every few months or years, you'll need to maintain or replace something that you own. Maybe it'll be a new roof, water heater, oven, washer dryer, or just a few $100s on car repairs. Now I know 3 to 6 months may seem like a pretty wide range, but determining what's right for you is a bit more of an art than a science. The focus here should be on your risk tolerance and your financial obligations. The less savings you have, the more exposed you are to needing personal loans and credit cards, which can destroy your wealth in the long run. A young professional with no dependents and a steady income is likely safe on 3-month savings. A married homeowner with children may be better off leaning further toward the 6 months, especially if there's only one significant source of household income. I'm about to show you my favorite reason to have an emergency fund, as well as a few ideas on which vehicles you may want to use to store money that you set aside for this purpose. And a quick reminder to like, subscribe, and share if you're getting value from this video. So we know that we can use emergency savings to keep ourselves from taking on or increasing our debt when big expenses come our way. But my favorite, and what I see as the long-term purpose for your emergency fund, to be able to freely commit more of your income to investing, as in compounding your wealth. The first time I learned how important this can be was as a 7-year-old, learning how to play the board game Monopoly. One of the reasons that I used to get spanked like a small child and mercilessly bankrupted is that I built too much, too quickly. You see, if you build those fancy houses and hotels, and subsequently land on a property you can't pay for, then what? Well, you have to reverse build or sell back those property improvements for cash. The catch is that you only get half of what you paid for them when you're forced to sell them. Taking out debt, pulling from your 401k, or being forced to sell out of investments during a steep market downturn, all of these financial atrocities effectively mirror what used to happen to me when I first started learning board games. Early in our series, we reviewed how $3,000 worth of credit card debt At a 19% interest rate, paid at a rate of $50 per month, every month to get rid of it would cost you a total of $9,535. Early withdrawals from your retirement account typically result in a 10% penalty, as well as income tax for the tax year which you made the withdrawal. That usually amounts to losing about a third of whatever you withdrew. Not a favorable situation in my estimation. I don't know about most people, but I absolutely hate to reverse build. Once I commit money to grow, I want to be absolutely certain that I can leave it alone to do just that. Now, what vehicle should you use for your emergency fund? You have a few options here. Traditionally, people use their local bank savings account. It bears interest, unlike most checking accounts. And it is a separate account, so it's less tempting for you to raid for spending binges. My only qualm here is that the interest rates offered by many big banks can be downright insulting, as in 0.01%. I know that getting interest isn't the main reason to have emergency savings, but at that rate, it'd take you 5 years to make 50 cents on $1,000. For a higher rate of return, you may want to consider what's known as a high-yield online savings account. The returns are not that high, but will likely be multiples of what your local bank offers you. As of this recording, you should be able to at least secure an account with 2+% interest. For comparison, $1,000 left for 5 years would make you around $105. Also keep in mind that you don't necessarily have to leave all of your emergency cash in the traditional banking system. U.S. Treasury bills that mature in as little as 4 weeks can supplement or be substituted for savings accounts. They are guaranteed by the U.S. government, and they're also state and local income tax free, so you keep more of your returns. The rates on these bills fluctuate, and they won't make you rich, but will protect your money while growing it faster than the average savings account. I left the link to the Treasury website in the description below if you'd like more details. With an intentional, focused budget and an emergency fund, there's one thing left for you to do in order to get your money right. Next time we dive into the fun part, compounding your wealth. Participating in what the vast majority of millionaires have done and are still doing. Investing. Leave your comments below. Your feedback helps me to improve the channel. Like the video, subscribe if you haven't already, and if you got value from this content, hit the share button to spread the wealth.